let's get started with our look at the fundamentals of a financial index. Throughout this session, we are going to explore what these indices are, how they are calculated, and why they matter so much to the world of investing. Moving on to the big question, what exactly is an index? You can think of it as a specialized gauge, much like a thermometer, that tracks how things are shifting within the economy. In technical terms, we call it a statistical indicator because it uses data to show us the direction of change in a specific area or across the general economy. Now, let's look at how this applies specifically to the financial markets. In this context, an index represents a basket or a portfolio of different securities. This basket is designed to represent a whole market or maybe just one specific slice of it. So we can see how that entire group is performing at a glance. Calculation methodology, we need to talk about how these indices are actually measured. Every index has a starting point, which we call a base value. This starting point might be from many years ago or as recent as yesterday. What this means is that the actual number of the index isn't the most important part. Instead, we focus on the percentage change from that base to see how much growth or decline has happened. Moving on, it's important to realize that indices aren't just for stocks. While we often hear about the stock market index, they are also created to track bonds, T-bills, and many other types of financial assets. Essentially, a stock index gives us a clear picture of the average movement of share prices, helping us understand the general behavior of the equity market. Significance of the stock index. Let's look at why we actually use these indices. They serve three major roles. They act as a signal for how the market is doing, they provide a standard for comparison, and they serve as a foundation for more complex financial products. You can think of these as the three pillars of why indices are so vital to investors. Next, let's dive into that first role, being a performance indicator. Think of this as a health check for the market. By looking at the index, you can immediately tell if the overall market or perhaps a specific sector like technology or energy is in a healthy uptrend or if it is struggling. Now, let's look at the second role, which is acting as a benchmark. This is like a yardstick used to measure success. Professional money managers, like those running mutual funds, use the index to evaluate their own performance. If their fund isn't keeping up with the index, they know they need to adjust their strategy. Moving forward, the third role involves something called derivatives. In this case, the index acts as the underlying asset. This means that other financial products which are traded either on official exchanges or privately use the value of the index as the basis for their own price and structure. To wrap things up, let's recap the core ideas we've covered today. We've learned that an index is a statistical tool made of a portfolio of securities that tracks economic changes. We saw that the focus is always on the percentage change from a base value. And finally, we looked at how indices serve as vital indicators, benchmarks, and foundations for the entire financial world.